The world of stocks and shares has its own language. It's sort of the opposite to pretty much every planet in the Star Trek universe, who, rather handily, all seem to speak English. So when it comes to the stocks and shares lingo, how can you come across like a native rather than Chewbacca? Fortunately, our jargon buster is here to help. First up, there are bulls and bears. This is nothing to do with American football, I don't think. Bulls are investors who expect the market prices to rise, which can be described as a bullish market. On the flip side, you've got bears. Bears are investors who expect the market to fall. This is described as a bearish market. You can remember the two by thinking that bulls use their horns to toss up their prey, whereas bears use their paws to strike their prey down. Keeping the animal theme going, you might also hear of pigs and chickens. Definitely not anything to do with American football. Pigs are traders who are driven by greed, and chickens are those driven by fear. It might be an unfortunate part of human nature, but most traders are driven by either one or the other, and this ensures that markets will always go up and down. Another term that you will hear is EPS. This stands for earnings per share, and is probably the most important indicator for working out a share price. It indicates how much of a company's profit is portioned to outstanding common stock in the company. This means that EPS helps as an indication of a company's profitability. The easiest way to find the EPS of a company is to search for it online. As well as EPS, there are a few ratios that you also need to be aware of. First up is the price to book, or PB ratio. This shows the value of a company that was ripped apart and the individual assets are sold instantly. This sort of trading might sound a bit Gordon Gekko, or if you prefer, Pretty Woman, but it happens in the real world too. PB ratios help investors because some companies within mature sectors or industries have limited growth but have valuable assets such as property, land, equipment and other tangible items that can be sold. The lower the PB, the more likely it is that an investor is protected. Next up, there's the price to earnings, or PE ratio. This is useful to work out how long it would take to pay back your investment in the shares. Shares can move up in value regardless of positive earning reports. That's the profit and losses of a company. And the PE will generally identify whether the shares will hold their value. PE ratios can be compared against various companies to get the best returns, but it only works when you compare companies within the same sector or industry. You can calculate a PE ratio by taking the price of a share and then dividing it by the earnings per share, or EPS, to give you your answer. Finally, there's the PEG ratio. PEG stands for price to earnings growth. It's slightly different to some other measurements because it uses a company's historical growth as well as earnings and price. Investors compare PEG ratios of companies because they can see what it costs to profit from the growth of each company. As a rule of thumb, the lower the PEG ratio, the better returns you can expect based on estimated earnings for that company's future. You can calculate the PEG for a company by taking the PE ratio, then divide it by the year-on-year growth rate of its earnings. And so there you have it, your whistle-stop guide to stocks and shares jargon. Here's a quick recap. Bulls, investors who think the market will go up. Bears, investors who think it will go down. Pigs, investors motivated by greed. Chickens, investors motivated by fear. EPS, earnings per share. PB, price to book. PE, price to earnings. PEG, price to earnings growth. And Dallas Cowboys. No, sorry, no, that one actually is just an American football team.